meeting. You're listening to the news on RTHK.
RTHK Radio Free. Money Talk.
Good morning, it's 8:03 on Radio 3. We've made it to Friday. Welcome to Money Talk. There's chaos in the markets, some big individual stock moves, and confusion with central banks. Oil and metals prices take another tumble, sending stocks and emerging market currencies sharply lower. And the world's central banks add to the uncertainty. Fed officials openly disagree with each other on whether the conditions have been met for an interest rate rise. Mario Draghi threatens more stimulus unless Eurozone inflation picks up. And the Chinese yuan has been fixed lower for the 8th day in a row by the People's Bank of China. Is this the beginning of a new devaluation? We'll discuss all those stories and their implications with our markets guest, Michael Every, Head of Asia Research at Rabobank. We'll also look at Bitcoin with Simon Dixon, CEO and co-founder of BnkToTheFuture.com. And we shall have our regular Friday view from Australia. This week with former banker and author Satyajit Das. You too can join in with the discussion. You can text us on 6393 59 25. Email us, moneytalk@rthk.hk. We're on Facebook, Money Talk and RTHK Radio 3. And also on Twitter, @MoneyTalkR3.
Money Talk on RTHK Radio 3.
You're listening to Money Talk on RTHK Radio 3.
And we're joined now by Simon Dixon, who is the CEO and co-founder of BnkToTheFuture.com. Good morning, Simon.
Good morning.
Thank you very much for joining us. So can you explain, first of all, to our listeners a little bit about Bitcoin? What is the difference between Bitcoin and a normal currency that they're used to using in their banks and when they go shopping?
So the first thing is that Bitcoin is a global currency, and it kind of acts like cash. It's digital cash for the internet. It has no borders. It works anywhere, and it can be transferred completely free. Which is fairly different. To understand the core difference between Bitcoin, it's worth comparing it to banking. And the main difference is that there's three fundamental properties of putting your money in a bank that are different from Bitcoin. The first is that when you deposit your money with a bank, the bank actually becomes the legal owner of your money. So in countries like Cyprus, they experienced what happens when banks reclaim ownership of your money. Your deposits go. With Bitcoin, you actually own your own money. So it's much like storing cash or gold under a mattress. It's in your phone, it's on your computer, it's in your hard drive, you own it, it can't be taken. The second property is that with banking, when you deposit your money at a bank, the banks actually spend that money and they speculate on money. And if the bank's speculation goes wrong, as we saw in the crisis, then your deposit is actually at risk and it has to be guaranteed by government because of that. With Bitcoin, you spend your money as you wish, person to person. So there's no bank in the middle, there's no government in the middle. You're just simply transferring value from one person to another. And the final is actually the monetary policy, how it's created. So with banks, they actually create money when they issue loans. And so most money is created privately by a bank. With Bitcoin, it's created in a very geeky, hard to understand way. But essentially it's thousands of computers, hundreds of thousands of computers all around the world. And they all verify transactions. And every time they verify transactions, new Bitcoins get created. But it acts much like gold, where it's a fixed supply. So therefore, it's a deflationary currency, and the value tends to go up overall because it's fixed, it can't be manipulated, and the money supply never changes.
And does anyone supervise or oversee the creation of that, so that unlike with, in a traditional currency where the central banks can print almost unlimited quantities and inflate its value away, that can't happen really with Bitcoin, can it?
It can't, because it's regulated by maths and code. The monetary policy is known any time in the future. I could tell you the exact monetary policy in 32.6328 years from now. And it is overseen by, which is a hard concept for people to understand, but every single transaction is actually verified and audited by hundreds of thousands of computers all around the world. And in order to actually hack or manipulate it, you need to hack in simultaneously to hundreds of thousands of computers. And to put this in scale, it is now backed by the largest supercomputer in the world. If you sum up the 500 largest computers known to mankind, and you multiply that by 5,000, you get the size of Bitcoin computer power. So we've now got this computer that's auditing every transaction, that's hundreds of thousands of computers, that's 5,000 times larger than the sum of the 500 largest computers. So it's an amazing thing.
So even though you know Bitcoin's monetary policy for years into the future, nevertheless, the price of it is very volatile, isn't it? It's had some enormous swings over the last few months.
Well, that's the very interesting thing about Bitcoin, and why it's an interesting investment class and attractive to traders, is that it's very volatile. Not only is it a currency in that you can transfer money anywhere in the world for free, but it also acts as a commodity because it's a fixed money supply, and therefore that creates volatility. It also acts like a stock as well, in that Bitcoin is not just a currency, it's an invention, it's programmable money. And programmable money means you can do things with money that you couldn't do before, which acts like a stock. The value of Bitcoin is determined by how valuable this programmable money is to financial services.
And is it safe? We've seen some of the exchanges that trade that go bankrupt and people lose their money. For ordinary investors here in Hong Kong, is it safe and secure for them?
Well, Bitcoin itself is one of the most secure ways of transferring value around the world. What isn't safe is that you need to take care of your own security. So before I said when you deposit your money with a bank, the bank becomes a legal owner. That comes with the added bonus that they take care of security for you. So with Bitcoin, because you own your own money, you need to take some kind of responsibility for understanding and learning how to secure them. Now, you can secure them offline. I even have some banks which are secured offline on a piece of paper at a bank, ironically. But you just need to you need to learn a little bit more about how it works. So for the average person that's not interested in learning anything about technology, more and more services have to be created to take care of that. Now, the exchanges that went bust, and the exchanges, there's been lots of bad financial institutions and bad players. But that's a bad financial institution. It's not Bitcoin itself. But because Bitcoin's new, when an exchange goes bust or there's a bad player, they tend to blame Bitcoin when Bitcoin's working perfectly well and there's been no scandals with the actual currency itself. So
would you recommend it to ordinary retail investors as an investment?
It's a very high-risk speculative investment, but for me it's been the highest performing asset class in my portfolio, and it's acted as a hedge against some kind of financial uncertainty. So if you're forecasting financial uncertainty and you've got a portion of your portfolio that you're willing to lose, then I should say it's a good thing to have in your portfolio.
OK, well, we've got to move on, but very interesting. Thank you very much for joining us, Simon. That's Simon Dixon, who's the CEO and the co-founder of BnkToTheFuture.com. US stocks have tumbled overnight following another fall in commodity prices. The S&P 500 index is back in negative territory for the year. It fell 1.4% to 2,045, with the energy and materials sector leading the market lower. The Dow Jones Industrial Average, that plunged 254 points to 17,448. Caterpillar, a component of that index, fell 4.4%. And the Nasdaq, that fell 61 points to 5,005. More problems for US retailers. Nordstrom is down 20% in after-hours trading after cutting its profit forecast for the year. In the UK, the FTSE 100, that's closed 1.6% lower with some big falls in heavyweight names. Shares in Rolls-Royce, they plunged 22% following the fourth profit warning in a year due to a slowdown in business from Asia. And minor Glencore has fallen 7.6%. Its shares are back below £1, closing at 95.92 pence. And commodity prices, they're having another meltdown. Brent crude oil has fallen 3.8% to $44.06 a barrel, and US crude has tumbled 3% to trade at $41.65 a barrel. That's the lowest in 2.5 months. It follows a US government report showing that stockpiles were 4 times larger than traders had expected. Copper, that's fallen 2.4% overnight on the London Metals Exchange. It's fallen now 7 days in a row. And gold is down $1 at 1,084. And the price of platinum has also fallen to a 7-year low. It's down almost 7% this week. And in the currencies, the US dollar index, that was down 0.4%. And the euro is up 0.6% on the day. And a quick look at here in Asia, the ASX 200 in Australia, that's trading down 2% right now. China futures are indicating a fall of 1.2% in mainland Chinese stocks at the open, and Hang Seng futures are indicating a fall of about 1% in Hong Kong stocks when they get going later today. All the Friday business headlines coming right up. We're joined on the phone by Michael Every, Head of Asia Research at Rabobank. Good morning, Michael.
Good morning.
Thank you for joining us. Let's start with commodities. We're seeing a renewed sell-off in oil and metals. The Bloomberg Commodities Index, which is a broad basket of 22 commodity futures, it's fallen to its lowest level since the financial crisis. So what's the cause of this latest downswing that we're seeing now in metal and oil prices, Michael?
Well, I think it's twofold. First of all, growth is still slowing globally. And on the other hand, we've got the Federal Reserve in the US still edging towards raising interest rates against the backdrop of a slowing global economy. So that's a real double whammy.
And the Fed seems to be in some disarray itself, doesn't it, about what exactly it's going to do. We've seen a number of speeches overnight. We saw Bill Dudley saying last night that the Federal Reserve will have waited too long if policymakers wait to see what he calls the whites of inflation's eyes. On the other hand, Charles Evans says that they should wait to raise interest rates because inflation isn't high enough. So I suppose it's not surprising that investors and markets are getting confused, is it, when you hear all these conflicting statements coming from voting members of the Fed?
Yes, absolutely. Markets are confused. The Fed is confused. And frankly, to be honest, they're right to be confused because if you look at certain sectors of the US economy, certain regions of the US economy, even in geographic terms, they're doing extremely well. If you look at others, they're struggling. You know, we have a very bifurcated, almost parallel economy at the moment. So if you look at some areas, absolutely, you should be saying rates need to be a lot higher than they are. You look at others, you say rates need to stay very, very low as far as the eye can see. And that's really the dichotomy that the Fed is struggling with, and the market is too.
And we're seeing that elsewhere as well, aren't we? We're seeing that in China, for example, where you've got a sort of two-speed economy. The consumer's doing well, but the industrial sector's slowing down. It seems to be maybe a similar story in the US.
Absolutely. I mean, we're used to thinking in national terms, America going up, another country going down, etc., etc. I think part of the new normal we're in now, in an integrated global economy, and particularly one that's so heavily dominated by central banks, is that parts of every economy do well, and parts of every economy do badly at the same time, which makes basically monetary policy that much harder.
And the Fed officials all seem to be focusing today on inflation, but I presume the chances of inflation increasing in the future depend very much on whether the economy itself continues to improve, doesn't it? Is that going to happen, do you think?
Oh, absolutely. I mean, on one hand, if we do get a bounce in commodities, which is possible, they've fallen a long way, that would obviously give inflation a push to a certain extent. But traditionally, the only thing that the Fed and other central banks really worry about from an inflation perspective is if salaries start going up and you get inflation being pulled higher by workers, effectively. And there is absolutely no sign whatsoever of that happening, apart from a few lucky professions who are pretty much ring-fenced from the labour arbitrage that everyone else is suffering from internationally.
So if that's the case, despite the fact that there are some signs in some places of the job market improving, as you say, wages are very low. If anything, inflation's going to tick even lower rather than go up, which rather detracts from raising interest rates in the US.
Well, I think we're stuck in lowflation as far as the eye can see, purely because, as I said, no one has any labour bargaining power anymore. Now, the Fed are looking at the fall in the unemployment rate on a headline basis and expecting wages to start ticking up there soon. You know, I've been putting forward a theory for quite some time that effectively the US economy is starting to look much more like an emerging market, where if you look on the official data in a country like Thailand, for example, you've got unemployment of less than 1%, but you still don't get any wage inflation because, people are employed just trying to make ends meet, selling fruit on the streets or whatever. They're not unemployed, but there's no wage inflation.
And is that because many of these jobs now, if you look at the construction of the job market in the US, where you see these jobs coming, they tend to be in low-paid jobs, poorly paying sectors, seem to be part-time jobs, and also it seems to be older people who are providing a lot of that jobs growth, whereas younger people don't seem to be joining in the labour force. So that I presume that means that it's going to be very hard to generate wage inflation under those circumstances.
Yeah, you're absolutely right. Everything you've said is completely true. And if you look at the younger generation, the millennials, whatever you want to call them, everyone likes to be, presented as these dynamic, tech-savvy young consumers. Actually, most of them, if you look at it, we end up basically working as freelancers, which means you've got no holiday pay, no job security, no health benefits, etc., etc. And if we go back to the old Marxist terms of the workers of the world unite, they seem to think that means meeting on Facebook. And frankly, that's not going to do a lot for wage pressures.
So in terms of commodities, which one's the chicken and which one's the egg here? I mean, commodities prices are now back to where they were 10 years ago, which seems a bit of an overreaction. Is it that's causing inflation and hence the markets to come down? Or is it the lack of inflation that's causing further declines in commodities?
Well, I think you can get a bit of circularity, of course, as you can in every particular market, a bit of reflexivity. But generally speaking, I think it's just a fall-off in demand globally, and that we've seen Chinese overinvestment tail off rapidly, and there's still a lot more to go in terms of how Chinese investment will slow. And given that no one else is picking up that slack anywhere else, really, to the same scale, then I think commodities are right to price, for a lower price future.
And let me ask you about the PBOC. They weakened the yuan yesterday for the 9th straight day. So this is now the longest streak of weakness since August 2008. And they set the midpoint 14 basis points lower. Is this another devaluation now, or are we seeing a devaluation by 1,000 cuts here?
I don't think so, to be honest. I saw that headline coming through yesterday and immediately ran to have a look at the screen. You'd need a microscope to see how much they're devaluing over the last 8 days. It's 8 quantum steps that you really can't even see with the naked eye. Now, I am a firm believer that they will devalue, and they'll devalue on a very, very evident, earth-shattering scale over the next 12 to 18 months. But we're certainly not seeing it yet.
But nevertheless, the cumulative effect of what's happened has now cancelled out that rise that we saw in the yuan at the beginning of the month, hasn't it? So it's sort of we are seeing it be guided low, and presumably the Chinese economy does need a lower currency right now, given the weakness in it.
Well, I mean, it does if they want to get a 6.5% aggregate growth figure. Because the retail sector is doing okay. We've seen those data. Yeah. But the retail sector alone isn't going to be enough to get 6.5% growth when investment and exports and manufacturing are all struggling. And the only way they're going to improve those is with a weaker currency.
Yeah. Now, the front page of The Economist today is talking about the third leg, if you like, of the financial crisis being an emerging market debt crisis. And they do mention China in that article as well. Is this something that is likely to become increasingly a problem, the debt burden of Chinese companies?
Oh, absolutely. Absolutely. It's been blindingly obvious for years and years that China has been piling on the debt in response to the crisis triggered by Western economies piling on the debt, which of course, triggered the original leg of the crisis in 2008, 2009. And effectively, historians in the future are going to look back and say this was all the same crisis, with just an interregnum, basically, when it just shifted from one region to another. We haven't completely dealt with it in the West yet at all. We've extended and pretended and devalued and benefited from lower commodity prices recently. But it's just been shifted east, and how the East deals with it will reflect how it comes back and bites the West again.
And many emerging market economies have got corporate debt which is denominated in US dollars, so a rate rise, if that occurs in December, is going to be pretty tough for them, isn't it, I would have thought?
Oh, absolutely. That's one of the reasons, again, why commodity prices are falling, because you've already got this worrying global backdrop, and you've got the Fed effectively saying, the dollar is our currency and your problem.
Right. Okay. Well, thank you very much for joining us, Michael. We've got to move on, but it's always a pleasure to talk to you. That's Michael Every, who's Head of Asia Research at Rabobank. The time is 8:16.
You're listening to Money Talk.
Money Talk on RTHK Radio 3.
We always like to have a view from Australia to end the week, and we're joined by Satyajit Das, who's a former banker and author. Good morning, Das. Thank you for joining us.
Good morning.
Let me ask you quickly, first of all, about the Australia jobs report that came out yesterday, because it was quite a stunning piece of data. The Australian economy added 58,600 jobs in October, the most in 3.5 years, completely blew away economists' expectations, and September's figure was also revised higher as well, and the unemployment rate as a result has fallen from 6.2 to 5.9%. The Australian press is almost incredulous at this, isn't it? Is this data believable? Is the Australian jobs market really as good as that?
I don't think so. And if you look at this number, it's certainly far greater than anybody anticipated, though, as we all know, economists were only put on earth to make meteorologists look good. But basically what actually happens is that we've seen this in the past. We saw this in 2012. We saw this in 2011, when you get one or two very, very high numbers, and then there is a process of revisions that go on. Certainly, it's unlikely that there will not be negative revisions to this. The first thing that I'd say on that. The second thing I would say is if you look at the Australian jobs market, we have a number of headwinds. The first one being, obviously, the slowdown in the mining sector, and also the housing boom that's been going on. The central bank and policymakers have been trying to slow it down, and there are signs that it's actually slowing down. Certainly the credit flow, particularly into investor housing rather than owner-occupied, has slowed. So that does not actually fit very nicely with the employment number. Mm-hmm. So I would expect to see some revisions at some stage.
Okay. Well, we've just been talking about Bitcoin. I don't know if you heard the end of that conversation and why more and more people are looking at it as an investment and also an alternative source of currency. Is one of the reasons people are attracted by this is because central banks have now held rates so low for so long that savers are in effect having their savings destroyed, aren't they? If you're a pensioner or you're looking towards some sort of long-term savings, you're really not going to get much support from the global central banks.
Well, more to the point, it's a deliberate policy because in Europe, basically, we have negative interest rates, and it's very likely that in the next couple of months, the European Central Bank will make its deposit rate, which is minus 0.2%, even lower. And recently, Andrew Haldane, who's the chief economist at the Bank of England, gave a speech at which he actually proposed banning cash. And the reasoning was interesting. He basically said, look, interest rates are very low, fiscal flexibility is very low, it's almost inevitable we are going to have a major crisis in the near future, and central banks have no room to actually move. So basically, we want to be able to actually put in place negative interest rates, and large negative interest rates at that, which is nothing more than basically liquidation of unsustainable debt. But he then went on to say that obviously that policy can be negated by people taking money out and keeping it in cash. So you've got to prevent that. So you're absolutely correct. There is now a crisis of faith in central banks and policymakers, and that is what is manifesting itself, as certainly in many ways, one of which is obviously Bitcoins, which, as you pointed out in your interview, has considerable risks associated with it. The interesting thing, as a historical anecdote, is Japan has obviously run very, very low interest rates for close on 20 years, and during the 1990s, I recall very clearly that one of the growth industries in Japan was home safes. And that was simply because people were taking money out of banks, because of the low rates, and at that stage concerned about the banking system and keeping it under the mattress, quite literally.
And we've seen today various central bankers, Mario Draghi in particular, and various Fed policymakers talking about inflation being lower than target and therefore adding more stimulus. But we've never had, have we before, an extended period of negative interest rates that we're starting to see now. There must be some damaging consequences to that, surely. Does this add to the distortions that we're seeing in financial markets and the economy itself?
Well, very much so, because the first thing I would say is any policy is defensible if it's successful. Success covers a lot of sins. But the problem is this policy isn't doing anything in terms of growth and employment and investment, not in a material way. And the central bankers themselves have admitted this. And so on the other side, what we now have is all the dystopian elements of that, which is primarily in the way of asset price bubbles. And so effectively, we have no effect of this policy. That's number one. Then, of course, we have a couple of other issues as well. One is just it's going to be impossible to withdraw these policies. Now, we're all basically wetting our trousers and putting diapers on for a 0.25% increase in the Fed funds rate. Now, the reality is if the Fed puts up its rates by 1%, the U.S. interest cost goes up by $180 billion, from $400 to $580 billion. Now, that has immediate impacts, effectively, on the budget deficit and also on U.S. debt. So the point I'm making is you can't normalize rates because this whole set of policies has basically led to unsustainable debt becoming even more unsustainable. And the central banks basically are continuing with this policy, which not only impoverishes savers, but isn't very effective in any shape or form. Mm-hmm. And I think, it was Albert Einstein who once remarked that, doing the same thing over and over again and expecting a different result is the first sign of madness.
Yeah, well, I'd definitely like to continue this conversation. Sadly, we've run out of time today, but we're definitely going to have to try and continue at another time because I think it's a very interesting topic. That's Satyajit Das, who's a former banker and author down in Sydney, Australia. A quick look at the markets. Asian markets are now joining in the global sell-off. The Nikkei 225 is down 220 points. The Kospi is down 0.75%. The ASX 200 is down 1.9% here in Australia. I'll be back on Money Talk on Monday morning at 8 a.m. So in the meantime, have a great weekend. The weather forecast for today is going to be cloudy with occasional rain. Temperatures will linger around 24 degrees at first, moderate to fresh easterly winds, becoming northeasterlies later. And it will be slightly cooler with temperatures falling to around 22 degrees. The outlook is cloudy with a few rain patches in the next couple of days. Slightly cooler tomorrow morning. The temperature right now, 24 degrees centigrade. Relative humidity is 95%. Time for the half-hour news with Samantha Butler.
Education sector lawmaker Ip Kenyun has urged the chief executive not to delay in appointing a new chairman for the University of Hong Kong Council. He says CY Leung's failure to name someone since the former chairman's term ended last Friday is a real problem for the university as it hinders its operation. Mr. Ip, who's the convener of the HKU Alumni Concern Group, spoke to RTHK this morning.
I think searching for such a person should not be very difficult. The most important thing now is to get a person that is acceptable from all sides, particularly the teaching staff and the students and also all stakeholders of Hong Kong U and also the public. I think such a person who is acceptable by all sides will be able to lead the Council of Hong Kong U to regain the reputation that is already lost in the past few months.
There are rumours CY Leung wanted to appoint former Education Minister Arthur Lee but has delayed following public opposition.